How to understand stock market fundamentals. The stock market can seem like a bewildering maze, especially for beginners. Many investors dive into buying stocks based on tips or trends without understanding the underlying factors that drive stock prices. This approach can be risky and often leads to disappointing results. If you want to make informed investment decisions and achieve long-term success in the stock market, it's crucial to understand stock market fundamentals. In this video, we will address your needs by breaking down 3 key components of fundamental analysis: researching company financial statements, analyzing industry trends, and staying informed about economic indicators. By the end of this video, you'll have a clear roadmap to navigate the stock market with confidence. Point 1. Research company financial statements. Company financial statements are a treasure trove of information for investors. They provide a detailed look into a company's financial health, helping you assess its performance and make informed decisions. Example 1. Income statement. The income statement, also known as the profit and loss statement, shows a company's revenues and expenses over a specific period. By examining the income statement, you can determine whether the company is profitable. For instance, if you're considering investing in Apple Inc., reviewing its income statement will reveal how much revenue it generated from iPhone sales, how much it spent on research and development, and its overall net income. This analysis can give you insight into the company's ability to generate profits and grow its business. By looking at trends over several years, you can see whether the company's revenues and profits are consistently increasing, staying flat, or declining. Consistent revenue and profit growth often indicate a company that is performing well and has good prospects for the future. Additionally, the income statement can highlight any red flags, such as declining revenues, shrinking profit margins, or significant increases in expenses. Example 2. Balance sheet. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholders' equity at a particular point in time. This statement helps you understand what the company owns and owes, giving you insights into its financial stability. For example, looking at Tesla's balance sheet, you can see its total assets, such as cash reserves and factories, versus its total liabilities, including debts and accounts payable. This information can indicate whether Tesla is in a strong position to continue growing or if it might face financial difficulties. A strong balance sheet typically features a healthy ratio of assets to liabilities, indicating that the company has enough resources to cover its debts and invest in future growth. On the other hand, a weak balance sheet with high levels of debt compared to assets could be a warning sign of potential financial troubles. By analyzing the balance sheet, you can assess the company's liquidity, solvency, and overall financial health, which are crucial factors in making sound investment decisions. Point 2. Analyze industry trends. Understanding the broader industry trends can significantly enhance your investment decisions. Industry trends can impact a company's performance and its stock price. Example 1. Technology sector. In the technology sector, trends such as the adoption of artificial intelligence, AI, and cloud computing can affect the growth potential of tech companies. For instance, companies like Microsoft and Amazon are heavily investing in AI and cloud services. By analyzing these trends, you can predict which companies are likely to benefit from these technological advancements and have a competitive edge in the market. For example, the rapid growth of cloud computing has created significant opportunities for companies like Amazon Web Services, Oz, and Microsoft Azure. By recognizing this trend early, investors who bought shares in Amazon or Microsoft have seen substantial returns. Keeping an eye on emerging technologies and understanding how they impact different companies within the tech sector can help you identify potential investment opportunities. Example 2. Renewable energy. The shift towards renewable energy is another crucial industry trend. Companies involved in solar, wind, and other renewable energy sources are expected to grow as the world moves towards sustainable energy solutions. By keeping an eye on industry leaders like NextEra Energy or SolarEdge Technologies, you can evaluate how these companies are positioned to capitalize on the increasing demand for clean energy. For instance, the growing emphasis on reducing carbon emissions and combating climate change has led to increased investments in renewable energy projects. Companies that are well positioned to take advantage of this trend, such as those specializing in solar panels or wind turbines, are likely to see strong growth. By understanding the broader industry trends and how they affect specific companies, you can make more informed investment decisions and potentially achieve higher returns. Point 3. Stay informed about economic indicators. Economic indicators are vital tools for understanding the broader economic environment, which can influence the stock market and individual stocks. Example 1. Gross Domestic Product, GDP. GDP measures the total value of goods and services produced in a country and is a key indicator of economic health. A growing GDP typically signals a healthy economy, which can boost investor confidence and drive stock prices higher. For example, if you notice that the GDP growth rate in the United States is increasing, it might be a good time to invest in U.S. stocks as the economy is expanding. Monitoring GDP trends can help you anticipate changes in the stock market. For instance, during periods of robust economic growth, consumer spending generally increases, leading to higher revenues for companies and potentially higher stock prices. Conversely, during economic downturns, GDP growth may slow or become negative, leading to lower corporate earnings and declining stock prices. By staying informed about GDP trends, you can better time your investments and manage your portfolio's risk. Example 2. Unemployment rate. The unemployment rate indicates the percentage of the labor force that is unemployed and actively seeking work. A high unemployment rate can suggest economic trouble, which might negatively impact stock prices. Conversely, a low unemployment rate usually reflects a strong economy. Monitoring the unemployment rate can help you gauge economic stability and predict market movements. For example, during times of declining unemployment, consumer spending typically increases, benefiting retail and consumer goods companies. For instance, during the economic recovery following the 2008 financial crisis, the unemployment rate in the United States steadily declined. This decline signaled improving economic conditions and increased consumer confidence, which contributed to a bull market in stocks. By paying attention to changes in the unemployment rate, you can gain insights into the health of the economy and its potential impact on different sectors of the stock market. Conclusion. Understanding stock market fundamentals is essential for making informed investment decisions. By researching company financial statements, analyzing industry trends, and staying informed about economic indicators, you can gain a comprehensive view of the market and its potential. This knowledge empowers you to choose investments wisely, mitigate risks, and ultimately achieve your financial goals. Whether you are a novice or an experienced investor, these strategies will help you navigate the complexities of the stock market with greater confidence and success. Investing in the stock market requires patience, diligence, and continuous learning. By mastering the basics of fundamental analysis and staying informed about the latest trends and economic indicators, you can build a solid foundation for your investment journey. Remember, successful investing is not about chasing short-term gains but about making well-informed decisions that align with your long-term financial goals. Happy trading!